Look at the chart on your screen right now. Ignore the price for a moment. Just focus on the line. That massive vertical wick shooting up from the top of the candle isn't just a line. It's a crime scene. Silver flashed to 83.71 in an instant. It didn't drift there. It teleported. 1 minute we were hovering around $79. The next we hit $83. Then, just as quickly, the rug was yanked out. If you're a new investor, you're probably terrified right now. You're staring at that drop and thinking the rally is dead, the bubble has burst. But if you're a veteran who survived the chaos of 1980 or 2011, you know exactly what this is. A classic stop hunt. A calculated algorithmic assault designed to liquidate leveraged traders who chase the Sunday night gap. The banks spotted liquidity drying up during this low-volume ghost week. They saw the order book was thin and empty, so they let price run up to $83 to lure in retail FOMO money. And when the trap was sprung, they slammed it shut. In this emergency market analysis, we'll dissect the anatomy of this $9 swing. We'll examine that shooting star candle forming on the daily chart. We'll explain why this volatility is actually healthy for the long-term uptrend, even if it feels like a heart attack right now. And most importantly, we'll show you why the physical price of silver didn't drop $9 today. The paper market is whipping around like a flag in a hurricane, but the flagpole remains rock solid. This is the story of the Monday rug pull. To understand why silver plunged from $83, you have to know who was buying at those levels. It wasn't smart money. They loaded up at $30, $50. The buyers at $83 on that Sunday night gap were chasers. The FOMO crowd, piling in with 10x leverage, dreaming of quick riches. The banks have databases tracking exactly where these traders place stop-loss orders. Most who bought around $80 set stops at $75. So the banks engineered the drop, dumping massive blocks of futures at the highs, pushing price down through $79, $78, then triggering the stop-loss cluster at $75. Thousands of retail sell orders fired off at once, creating a cascading waterfall of forced liquidations. Price plummeted to $74.47 purely on those margin calls. And who was waiting to buy at $74? The same banks that sold at $83. They sold high, forced you to sell low, then scooped up your positions at a discount. And this is rinsing the leverage. Brutal, unfair. But it's how the market flushes out gamblers before the next leg higher. Now, let's examine the chart pattern. This candle is a textbook shooting star or high wave candle, small body with a very long upper wick. That wick signals rejection. The market tested $83, but sellers overwhelmed buyers and shoved it back down. Typically, a shooting star suggests a pause, with buyers exhausted after the climb. We could chop between $75 and $80 for a few days. Don't expect a straight shot higher tomorrow. The market needs to digest this massive move. But here's the key insight. Compare today's close to Friday's. We closed Friday around $71.91, and now we're trading near $78.36. Despite the smash from the highs, we're still up nearly 10% from last week's close. Ignore the wick and the $83 flash. This remains a huge green day. The uptrend is intact, the breakout valid. The only change? The easy money phase is over. Now we enter the volatile grind. Let's talk gold. It's sitting calmly at around 4,414. It's down just a few dollars. That's stability. While silver whipsaws like a wild animal, gold holds steady near all-time highs. This screams that the monetary system is still broken. Gold is the anchor. As long as gold defends $4,500, silver has a secure floor. Silver is just the high beta sibling. It overshoots on the upside and downside. This volatility is the price of admission. If you want silver's explosive gains, you must endure its swings. If you panicked at $74, you were overleveraged. Physical holders didn't flinch. They glanced at the screen, saw the drop, and went back to dinner, knowing an ounce is still an ounce. We warned about Ghost Week, creating air pockets from low volume. Today proved it. Price fell $9 easily because the middle of the order book was hollow. It plunged through the gap until hitting big limit buy orders from industrial whales at $75. Notice the bounce from exactly $74.47, right at last week's breakout level. Old resistance turned into new support. The market tested it and held perfectly. Whales were waiting there, aggressively buying the dip and pushing us back to $78. This confirms the industrial bid is real. Samsung, Tesla, and solar giants didn't chase 83. They're too smart. They waited for the banks to smash it, then loaded up cheap contracts at $74. Smart money buys weakness, dumb money buys strength. Today was a massive wealth transfer from dumb to smart hands. The rug pull hurt, but it cleared the weak hands and excess leverage. Now the real bull can run. Stay with us as we probe the physical supply chain's pulse. Don't let volatility shake you out. While paper price crashed from $83 to $74, what happened at coin shops? Did dealers panic and drop prices $9? No, they held firm. Some even raised premiums. This is the strongest signal for physical investors. Spot crashed, but street price stood strong. Dealers know paper volatility is noise. They won't sell Eagles at $78 if price could snap back to $83 in minutes and cost them inventory. They treat physical metal as a stable store of value and paper as a broken casino. If you waited for a dip to buy physical, you likely missed it. That $74 window lasted minutes, with sites crashing or showing out of stock. This proves it was a paper event, not physical. No flood of real selling, no lines dumping bars, just algorithms dumping futures. In a true bear market, physical holders panic sell. In a manipulated stop hunt, they hold tight. We saw holding in strength. The foundation is solid concrete, even if the roof shakes in the wind. Industrial reaction. Imagine you're a solar procurement manager needing silver on budget. You see $83 and worry, then $74 hits, and you celebrate, hammering the buy button. This $9 drop was a gift, letting industry hedge cheaper before year end. They turned the bank's manipulation against them. Banks smashed to clear speculators, but handed industrials a discount. That's why the bounce from $74 to $78 was so sharp. Industry absorbed paper selling and requested physical delivery. This builds higher lows. Last week's floor $65, this week's $74. We're stair-stepping higher, steeper, but unmistakably up. Volatility is a tax on leverage. Trading futures, options, or margin today, you paid dearly, but physical holders paid nothing. An ounce remains an ounce. You gained knowledge. The market can hit $83, showing true potential when suppression slips. That $83 flash was price discovery, a preview of where it heads without interference. Like holding a beach ball underwater. The grip slipped briefly, it shot to $83, then banks forced it back to $78. Now we know the stored energy. $83 isn't the ceiling, just the first milestone. Currency crosses confirm. Well, silver didn't just crash for its dollar, it crashed and recovered against everything. Dollar index flat means this was silver specific, not macro. No rate shift, no peace deal, just internal structure overload on the long side. The boat tipped, everyone fell out. Now it's righted and lighter. This cleanse is bullish for January. A straight run to $100 without correction would have invited a devastating crash, ending the bull for years. Flushing leverage now resets open interest, clearing the path for fresh capital. Pension funds are smiling. They didn't want $83, $78 is a bargain. The market just became more attractive to institutions. Wick psychology. That long upper shadow is intimidating. Rejection at $83 creates overhead supply. Bag holders from the top will sell to break even on retests, forming resistance. Don't expect at $85 tomorrow. We must grind through overhang, consolidate 75-80. Let moving averages catch up. This sideways chop is brutal, designed to bore you out as volatility fades and excitement dies. That's precisely when the next leg ignites. Gold-silver ratio compressed to the 50s at $83, back to 60 at $74, now 57 at $78. Trend is downward. Silver still outperforming gold. Even on a crash day, relative strength shines. Last week we celebrated $65. Today we're disappointed with $78. Perspective shift from the wealth effect. Bank solvency rumors, that 10% swing hints someone was in trouble, maybe a greedy long fund liquidated or bank desperately defending $80. If the latter, they burned ammo adding shorts, digging deeper holes. They kicked the can, but it's heavier now. Drop volume, massive on the way up, high but panic driven down. Panic selling exhausts quickly, structural buying endures months. Today's open and dip buying was structural. Tactical selling loses long term. Ghost week strategy, 3 days left to New Year's. Liquidity thin, another flash to $70 or $85 possible. Random walk rules. Stay out of crossfire, no loose stops. Today's $74 stops got hunted. Sellers hit bottom watching soar dollar recovery. Size small or hold physical, no stops exist there. Prepare for monthly close Wednesday, Deck 31, monthly and yearly candles close. Above $75 seals history's highest monthly close, massive green, yearly engulfing decades. Signals pension funds for 2026. Silver is the winner. Even with the wick, $78 close is triumph. Seals January effect. Don't let intraday violence blind you to the multi-year trend. Year ends on a high note. Volatility is noise, price level is signal. Trading near $80. If I said that a month ago, you'd call me crazy. Now disappointed it's not 90. That's progress. Next, January setup. how the shooting star affects algo buying, scares them, or discounts for institutions. End of year checklist before Dick 31 for tax turnover. The rug pull tested you. You passed. Now gear up for the real move. Into the machine's mind. Markets dominated by CTAs, robots controlling billions. They're recalculating off this shooting star. To humans, it looks like failure. To algos, extreme volatility, exploding risk metrics. They may pause aggressive buying, letting us drift and chop $75 to $80 like ping pong. This frustrates option and momentum traders, decaying time value and gratification. It's the wash cycle, clearing excess before the rinse. But algos are short-term, pension funds long-term, seeing monthly vertical trend, not shooting star, but discount, $5 OZ savings on billions. The rug pull boosted January effect probability. $83 might have scared funds as extended. $78 screams buy the dip. Crash cleared runway for institutional jets. Monthly close battle, 2 days left. Above $75, highest monthly ever, engulfing 10 years, killing bear market mathematically. New secular bull, 10-15 years, begins, ignoring Monday drops. Bulls hold $75. Bears need sub $70. At 78.36, bulls have buffer. They just run the clock. Minor psychology. Hecla or First Majestic CEOs saw 83s. Did they dump production? No, they saw manipulation. Broken market. Producers stopped trusting exchanges. Halt forward sales. You're hedging. Hold metal. Seller strike removes supply when banks need it most to cover shorts. If miners and stackers won't sell, who fed today's buying? Leveraged speculators on margin calls. Banks, 8 weak hands. Once gone, only strong hands remain. Who don't sell at $78? Watch comics reports. Crashes usually bring vault inflows from dumping. Prediction? Outflows even on crash. Industrials, Samsung, Tesla, solar. Took delivery on dip, draining physical while paper fights pennies. Price drop plus inventory drop. Bullish divergence. Shortage worsening. Geopolitics, world tense, Middle East, South China Sea. Silver is war metal, missiles, and no counterparty risk wealth. War closes, stocks, Josh bonds. Vault silver holds value. Smart money hedges. New Year risks in silver. Floors price prevents deeper crashes. $78 feels rich, but $0 from bank failure feels worse. Unit bias shift accelerating. At $83, silver sheds cheap metal label becomes precious again. Changes buyers, bargain hunters exit, momentum and allocators enter. $80 quadruples market cap, big enough for mid-sized funds without moving it. Higher price attracts bigger money. Soros reflexivity. Rise validates the asset class. The $83 crash hurt, but necessary. Shook tourists, welcomed institutions, staged perfect monthly close. Into Tuesday, Wednesday, expect chop, banks pinning below $80 for year end, but trend force is a rising river, dams break eventually, water is rising. Final chapter. End of year checklist, 48 hours left. Position for 2025's final bell. Verdict on shooting star, warning or invitation. Mindset for confident January entry. Storm past, ship afloat, set course. Before Wednesday night, audit leverage. If today's $9 swing sickened you, you're over-leveraged. De-risk, trim paper, shift to physical or fully paid miners. January volatility will exceed today, be unshakable. Watch $75 line. Today's $74.47 bounce confirmed new hard floor. Above it, breakout lives. Retest, buy, break below, reassess. Defend the fortress. Ignore intraday noise, volume pathetic, algos paint weird candles, wide spreads. Don't stare at screens, set alerts, walk away. Chop steals chips, don't play. Final verdict on the ugly candle. Textbooks call shooting star bearish reversal at tops. But context matters. At exhausted trend ends, yes, bearish. At breakout starts in holiday thin liquidity, often just a speed bump, liquidity test clearing books. Market tested $83, found sellers. $74, found buyers. Now knows the range. We'll trade it until January fresh money arrives. Don't let one daily candle scare you from a monstrous weekly, monthly uptrend. Looking ahead, 2026 looms. If 2025 was silver waking up, 2026, is it claiming monetary strategic reserve status? Setup perfect. Leverage flushed, high floor set, gold anchoring 4,500 plus, pension wall waiting. I believe $83 retaken in January's first weeks. The wick isn't sealing its target. Markets love filling wicks. Next test finds no sellers. They exited today. Clear path to $100, Q1 or Q2, but shortage physics demand it. Conclusion, today was engineered to scare. If easy, everyone wins. Market forces you to earn gains enduring volatility. You did. Held 74 tall dollars, holding $70. Diamond hands proven. Relax. You're nearly over. You're in the sole asset shielding debt collapse while capturing energy boom. Hard work done. Let January effect lift. Enjoy New Year. Keep stacks safe. Get ready. Today was wild. Wait until real money arrives. The rug pull failed. The bull lives and rages. Subscribe.